Welcome to the deep dive. So today we're going to get into a surprisingly advanced corner of finance. We're talking about how you actually price the risk that comes with, well, the weather.
And it's not a small niche. I mean, it's a huge deal.
Right. Some sources estimate that roughly $1 trillion of the U.S. economy is weather sensitive. $1 trillion.
Yeah, that's everything from energy consumption during, say, a heat wave, all the way to a retailer trying to figure out how many winter coats to stock.
So how do you even begin to put a price on that kind of risk?
Well, financial engineers quantify it using derivatives, and the underlying variables are usually these cumulative temperature metrics.
Okay.
We call them heating degree days, or HDD, and cooling degree days, CDD. You're basically just measuring how much the temperature deviates from a baseline, usually 65 degrees Fahrenheit, and you tally that up over a season.
And that number becomes the asset.
Exactly. That becomes the index for a swap or an option.
Which sets the stage perfectly for our mission today, to really drill down into an advanced equilibrium framework that's used to find the fair value for these instruments. It's a generalization of the classic Lucas 1978 asset pricing model.
And that's the key thing. Generalizing Lucas means you're tying the financial value back to the actual market sensitivity to temperature volatility, using real economic utility.
Based on real data.
Oh, yeah, 20 years of historical temperature data from across the U.S.
So what makes this particular model so robust?
It's the dynamics it captures. It's not just looking at averages. The model realistically incorporates seasonal cycles, autoregressive patterns.
Meaning that today's temperature affects tomorrow's.
Precisely. And critically, it lets you use current official weather forecasts as active inputs into the model.
Okay, so let's get to the most counterintuitive result that this whole framework produced. After all that analysis, the study found that the market price of risk tied to temperature is almost negligible. How is that possible? We're talking about weather, which is the definition of uncertainty.
It does sound shocking, right? But the data is really clear. Across all the different risk scenarios they tested, the changes in forward prices were consistently less than 1%.
Less than 1%. And options.
Option prices varied by less than 3.5%. It's remarkably stable.
So what does that mean in practice?
It means, and this is incredibly important, it provides this powerful indirect justification for what a lot of people in the industry already do.
Which is?
Valuing these instruments using the simple risk-free rate. If the actual temperature risk premium is that tiny, then practitioners are, they're pretty much justified in ignoring it.
So that validates one industry shortcut, but the analysis also fires a big warning shot about another common method.
It does. The historical simulation approach.
Right. Why should a firm avoid just looking back at the last 20 seasons to price a weather contract?
Well, the flaw is that historical simulation assumes next season's weather has the exact same probability distribution as the past 20 years.
Including all the extreme outliers.
Exactly. It's like trying to predict next year's game scores by only looking at the biggest upsets from the last 2 decades. You're completely biasing your outcome toward the extremes.
And the result of that bias is?
What? You get significant pricing errors. The technique tends to wildly exaggerate the impact of those rare historical events, and it consistently, substantially, overestimates the value of option prices compared to the equilibrium model.
So to recap for everyone listening, what you've gained from this deep dive is pretty clear. On one hand, you have validation for using the risk-free rate in pricing. But on the other, a really sharp warning to avoid the historical simulation trap, which can badly inflate your prices.
That's the key takeaway. But I'll leave you with one final provocative thought to consider.
Go for it.
The analysis shows that the value of an option on a single long seasonal contract, say May through September for cooling degree days, is significantly less than the sum of options on each individual month.
So an option on a whole summer is worth less than a May option, plus a June option, plus a July, and so on.
Exactly. So why would an option on the portfolio be worth less than the sum of its parts? Think about how correlation and the natural netting of uncertainty works when you blend different months together, something to explore as you apply this knowledge.